I want to bring in Brian Levitt, who's joining us from Invesco. He's a global market strategist. Brian, it's on the one hand a little bit baffling to folks who are following the situation. They see the amount of Americans who are out of jobs, and they see the market doing well. On the other hand, we know that this savage sell-off coming into this probably was expecting some pretty bad things to happen for the economy. So how important is it for us to watch stocks and see what they tell us? Can we get some information here on what might be expected and unexpected by investors?
Yeah, I mean, look, stocks are going to bottom before the economy troughs. I mean, we even saw that in the financial crisis. I mean, stocks bottomed way before the mortgage defaults peaked. So that's typically how it goes. I mean, it is a little interesting to see stocks up when we're seeing millions of our American friends file for unemployment. It's really more of the market had gotten way out ahead of this. A peak to trough decline of over 30%. That is a recessionary bear market, and so the markets priced that in quickly, and they priced in the credit markets a significant amount of defaults. The question is now, how much longer does this persist, and how effective are policymakers at easing financial conditions? And so that's what the market is watching now. A lot of this economic data is to be expected and so disastrous, almost to the point that the markets almost start to look through it.
Should we view this as a comment by the market, if you will, on policy? Should we view what's happening in stocks and the stability in bonds right now? Even today, there's not a rush to treasuries. Should we view that as a sort of validation of the response by fiscal and monetary side?
Yeah, I mean, I think it's certainly a near-term positive. I mean, we have to remember we've come a very long way in a very short period of time. I mean, it was only a few weeks ago that we were questioning whether Americans would even consider isolating or social distancing, and then we were waiting for a Federal Reserve response, and then after that, looking for a fiscal cushion. So that is all helpful. And it's helped to stabilize markets a bit. The big question now is how quickly the medical community can get out in front of this. I mean, we hear things about therapeutics, we hear things about antibody testing, rapid testing of individuals, and so all of that is hopeful. And to some extent, we've seen the Federal Reserve at least raise inflation expectations a bit. So that's hopeful as well. But none of this is in all clear. I suspect that, the markets, you see where the VIX is, markets are going to continue to be volatile. We don't know how long this is going to extend. And so the markets probably retest lower levels. What we do start to hopefully gain confidence about is a year from now, are we higher? I suspect we will be. And over the next couple of years, do we recover? I suspect we will. But this is all going to take a bit of time.
I think you guys have a very logical, very useful dashboard, is what you're calling it. Steps to establish a new market cycle. I'm on your Invesco blog right now for folks to go find it, blog.invesco.us.com. Step 1, looking at COVID-19 cases. Step 2, inflation, U.S. dollar stabilization. Step 3, commodities stabilize. And then 4, spreads tighten. 5, stock to bond ratio turns up. I think this is really interesting and largely in line with what we've been describing here on the show as the primary forces for the market right now. As far as COVID goes, we'll leave that to kind of the medical professionals debate how that's going to turn out. I want to talk about dollar and the potential for inflation stabilization here. The dollar had such a huge run. It continues to be strong. Is that going to be our sort of leading indicator for market structure and stability right now?
Yeah, I think so. I mean, we need to see financial conditions easing. I mean, we can't even begin to think about the start of a new cycle until financial conditions ease. So what was so troublesome a couple of weeks ago was just how financial inflation expectations had plunged and how strong the dollar was. And that is why you saw the Fed respond significantly and massively and aggressively. It's deflation is the worst of all outcomes, incredibly difficult to get out of. And so the Federal Reserve is all in. And that's what the bounce in inflation expectations has told us. That's what some moderation in the dollar has told us. And we're watching commodity prices. Typically an easing or at least moderating dollars should help to stabilize commodity prices. We got there. Obviously, some conversations right now between the Russians and the Saudis. to perhaps try to provide some support to that market would be helpful. And that's the path to easing financial conditions. That's the path to restoring some health in the credit market. And we'll ultimately get there. I think we use this dashboard on the 5-day rally we saw last week into the beginning of this week to say this is a nice relief rally. We needed this, but we're not at an all clear signal yet. We would need to see the dollar stable for a relatively reasonable period of time and commodity prices up a bit and inflation expectations up along with that to start thinking about the beginning of the next cycle.
Seems like there's a lot of steps here on this dashboard before we can determine what the nature of the leadership is in the style of stocks that might do well on the other side. I've gotten a lot of guests lately who said, look, you're going to want to already start playing this as kind of an emergence from recession, to be in cyclical names, to be in that type of style. It seems like you would say it's too early to even begin thinking about that. Is that correct? I mean, it seems like we have a lot of steps to go through before we determine what kind of stocks to buy.
Yeah, I mean, look, I've largely been a growth investor, and growth did well over the last 10, 11 years. I think we're in a slow growth world, and you want to invest in those companies that can generate true revenue growth and are on the forefront of the long-term secular trends. In this downturn, obviously, you wanted to be more defensive, but the growth names continue to do well. I know that there's this instinct to say that coming out of this, all of the stuff that got beaten up most, your more traditional early cycle names like the banks, like the airlines, like the energy companies, will, because they had been beaten up the most, will do well. And I suspect you will see a shift from defensive to the value-oriented cyclicals. But for my mind, this is, if you're a long-term investor, this only affirms my view that we want to be exposed to true growth companies. I think coming out of this, what we're going to find is an even slower growth world than what we came into it with, and it had already been a pretty slow growth world. And so while growth may accelerate in the near term, I think you go back to a sluggish growth environment. And for longer term investors, you're going to be benefited by identifying those companies that can generate true earnings growth.
The last 2 points of your process here, stock to bond ratio turning up, and then peak pessimism. We've seen some of the indicators towards pessimism, just fund manager surveys, holdings in terms of allocation have moved really far away from risk. But in terms of the stock bond ratio, what do you mean by that? Should we expect stocks and bonds to actually go in a different direction for once? Is that what you're saying, Brian, that the days of bonds and stocks rallying together might actually change?
Yeah, I mean, you're looking for a turn. I mean, we were in a sort of sell everything environment, and except the 2-year treasury, I suppose, or cash, and and so what you want to start to see is a turn in that. You want to start to see investors coming back. I mean, again, the markets are going to trough before the economy troughs, and so that's what you're looking for, a sustained climb in the stock bond ratio to suggest that investors are starting to think once again about risk taking. The market will be a good leading indicator of this.
Brian Levitt, great to catch up with you. Appreciate the walkthrough here of your guys' expectations. I like the dashboard, like the idea of a multi-step process. Lots to go here, but some of these things starting to come together. Brian Levitt, global market strategist at Invesco.